Silver didn't just cross a number. It broke the clock. Here's the contradiction. For decades, silver was treated like a slow, boring metal that followed rules. But now it's behaving like something else entirely, sprinting past $100 while those old rules fail in real time. And this matters to you, even if you've never bought an ounce, because this isn't just about silver. It's about what happens when prices stop moving in years and start moving in days. Silver moved from $90 to $100 in roughly 10 days. That kind of speed used to take months, sometimes years. When time itself compresses in markets, control disappears faster than people expect. But here's the part nobody is saying out loud. Once a psychological level like 100 breaks, the market doesn't pause to celebrate. It accelerates. Resistance stops acting like resistance at all. And right now, something deeper is snapping underneath the price. Not a headline, not a trade, a structure. If that structure is gone, the next move won't look rational, or slow, or polite. So what exactly broke when silver hit 100? Here's what actually happened, without the noise. Silver breached the $100 level, and gold pushed toward 5,000. The move from 90 to 100 took about 10 days, compared to roughly 145 days for silver to climb from 20 to 30 in an earlier cycle. That's not a normal breakout. That's a compression of time itself. But this wasn't an isolated spike. It fits a larger pattern already unfolding across metals. Once silver crossed 100, the market failed to consolidate at that level. Instead of pausing, price discovery accelerated. That tells us the pricing mechanism detached from traditional technical resistance and began responding to something more urgent than charts. Now notice what's missing from the story most people are telling. There's no evidence of orderly profit-taking, no calm digestion of gains. Instead, volatility expanded upward, feeding on itself, as higher prices attracted more capital, not less. This reframes the entire event. The question is no longer, is 100 sustainable? The real question is why the market no longer cares about sustainability at all. And once you see that, the next layer becomes impossible to ignore. Here's the claim that changes how this move should be read. This isn't a speculative spike. It's a melt-up driven by scarcity and speed. After silver crossed 100, projections shifted to a move toward 150 within weeks, not months. That projection isn't guesswork. It's grounded in the data showing how fast price increments are being absorbed. The move from $90 to $100 took about 10 days, while a much smaller move from 20 to 30 once took 145 days. That's a collapse in the time needed for price discovery. When markets move that fast, resistance levels stop functioning. They don't repel price, they get erased. Now notice what they didn't deny. There is no consolidation zone forming around 100, no technical base, no cooling off period. Instead, the market flipped from linear to parabolic behavior, the same kind seen during the late 1970s run when silver surged more than 400%. Volatility is expanding to the upside, not the downside. Higher prices are triggering faster buying, not selling. That's the opposite of how healthy, controlled markets behave. This is where the story flips. The price is no longer being negotiated between buyers and sellers. It's being chased. And when price starts outrunning hesitation, the pressure doesn't release upward. It transfers somewhere else entirely. That's where the next fracture appears. Now watch how fast this escalates. As price accelerates, the system that's supposed to absorb supply starts to fail. Major refiners have stopped buying junk silver and sterling silver, or are imposing payment delays ranging from 10 days to as long as 3 months. That's not a pricing issue. That's a liquidity issue. Dealers rely on speed. They buy, refine, sell, and repeat. When that cycle stalls, the entire retail pipeline backs up. Refiners will still accept pure .999 fine metal, like 100-ounce bars and kilos, but alloyed silver is being rejected. The market has split in two. Certain forms of silver are now illiquid at the wholesale level, even as spot prices hit records. This shouldn't be normal. In past bull markets, higher prices brought more supply online. Here, higher prices are breaking the infrastructure itself. The physical system was built for slow, incremental moves, not vertical ones. Here's why that detail changes everything. If dealers can't turn incoming metal into usable inventory, local supply dries up, no matter how high the price goes. Scarcity becomes structural, not temporary. And once a market loses its ability to rebalance itself, behavior changes fast. The next group to react isn't institutions, it's people. This is where the psychology turns dangerous. The breach of $100 didn't just move price, it rewired demand. Dealers report buying 6 figures worth of silver inventory daily, yet showcases remain empty. Product is disappearing faster than it can be replaced. A whole new universe of buyers has entered the market, many with no prior experience in silver at all. They're not comparing premiums, they're trying to get in. Silver has crossed into Veblen good territory. The higher the price goes, the more attractive it becomes. Demand is no longer price sensitive, it's momentum sensitive. Notice the contradiction. In normal markets, rising prices scare buyers away. Here, they're pulling buyers in. Longtime holders, the so-called stackers, see $100 not as an exit, but as vindication. Instead of selling into strength, they're holding tighter, reducing available float even further. Here's the line that permanently changes how this should be viewed. This isn't accumulation anymore. It's participation. People aren't buying silver because it's cheap. They're buying because it's moving. And when buyers stop asking, is this a good price, and start asking, will I miss the next move, the market stops behaving like a market. At that point, the price isn't leading psychology. Psychology is dragging price behind it. And the institutions watching this know exactly what comes next. This is where the pressure stacks, fast. Multiple systems start failing at once. The US Mint raised the price of proof silver eagles from the mid-$90 range to over $170 per ounce. That's not a retail premium adjustment. That's a signal. The Mint is no longer pricing for today's spot price, but for where it believes silver is heading. It's choosing not to chase price later by locking margins now. At the same time, the short side of the market is disappearing. Despite reports of millions of shares available to borrow, there is almost no appetite to short silver above $100. Attempts to do so are described as pure insanity. The entities that once capped price through paper leverage have capitulated. Then add the speed. Silver has been moving $10 in roughly a week. That's enough to force remaining shorts into liquidation, not by choice, but by margin pressure. The counterweight that normally slows rallies is gone. Now stack that with the retail frenzy and the refinery bottleneck. Supply can't clear. Shorts won't step in. Buyers won't wait. The system is losing its shock absorbers. Now shift the lens to where this actually lands. Local coin shops are seeing inventory vanish almost immediately, even at record prices. That means access, not affordability, becomes the problem. When markets move this fast, ordinary buyers aren't priced out first. They're locked out first. Think about what that does in real life. You don't see calm lines and thoughtful decisions. You see rushed purchases, fewer options, and widening spreads between what you pay and what you could sell for the same day. The fiction shows up everywhere. Time off work to chase inventory, long drives across state lines, missed opportunities because supply simply isn't there when you're ready. Notice what's quietly happening underneath. Buyers are navigating around taxes and reporting thresholds, breaking purchases into smaller chunks, choosing jurisdictions carefully. This isn't about profit anymore. It's about control and privacy. Silver is being treated less like an investment and more like an exit ramp from a system people no longer trust to behave predictably. This is why the emotion feels familiar. You've seen this pattern before. Maybe in housing, maybe in tech, maybe in groceries. The scramble, the sense that waiting equals losing. If this feels familiar, say so in the comments, because the reason it feels familiar has nothing to do with silver itself and everything to do with the system it's reacting to. Here's the part that's smarter than outrage. This isn't chaos, it's incentive math. Central banks are accelerating gold accumulation while reducing exposure to U.S. treasuries. Major economies are settling more trade outside the dollar. Those aren't emotional decisions, they're mechanical ones. When trust in a system erodes, participants don't argue with it. They route around it. Silver and gold benefit because they sit outside the leverage stack. No counterparty, no yield promise, just weight and custody. That makes them boring in stable times and magnetic in unstable ones. Now add the incentive layer. Banks operate under balance sheet rules, not headlines. Under Basel III, physical allocated gold is classified as a Tier 1 high-quality liquid asset. Paper claims are not. Institutions are rewarded for holding metal and punished for pretending to hold it. This quietly flicks behavior. Bullion banks that once suppressed prices through paper shorts unwind those positions and accumulate physical instead. Not because they believe in a narrative, but because the rules changed. Here's the unsettling insight. The system didn't break, it adapted. And in adapting, it redirected pressure onto price. When rules change faster than public understanding, markets don't move smoothly, they gap. And once gapping becomes normal, the next move isn't debated in public. It happens first. Now, look forward, because momentum is already splitting the path ahead. Silver is trading above 100 while gold approaches 5,000, compressing the gold to silver ratio toward 50-1. That level historically marks a transition point. It signals that silver is outperforming gold late in the cycle, not early. From here, two paths form. One is continuation. If physical shortages persist, if Eastern markets keep paying a premium, and if shorts stay sidelined, silver doesn't drift higher. It lunges. Targets like 150 or 200 stop sounding extreme and start sounding sequential. The other path is rotation. Sophisticated investors use ratio compression to lock volatility into stability. That means converting aggressive silver gains into gold, not exiting metals altogether. That rotation doesn't crash silver. It caps the speed. Here's the tension. Both paths require higher prices first. Either silver overshoots violently, or it rises enough to justify rotation. Notice what no path includes: a quiet return to $50. The next move is already forming, shaped by incentives, scarcity, and time compression. The only uncertainty is which pressure releases first. And that brings us to the final insight most people miss. Here's the sentence that reframes everything. Silver didn't get expensive. The system got exposed. When adjusted for inflation and money supply growth, historical models place silver's prior highs far above today's breakout. That means $100 isn't an endpoint. It's a recalibration point, a place where old assumptions stop working. This entire story looks dramatic only if you believe prices move independently of trust. But once trust erodes, price becomes a messenger, not a driver. Silver isn't leading this cycle, it's reflecting it. And that's why this move feels different. It's not about a trade, it's about a migration. From paper to physical, from promises to possession, from slow systems to fast exits. Here's the loop to hold on to. If silver behaves this way at 100, what happens when the next psychological barrier breaks? Because every level above this carries less resistance, not more. This story doesn't end with metals. It continues wherever systems meet stress. If you want clear, calm analysis as the next layer unfolds, follow and subscribe, because the next move won't wait for consensus.